The 2008 financial crisis didn't arrive out of nowhere. It wasn't a freak accident or a natural disaster. It was the predictable result of a system engineered to reward short-term profit, hide long-term risk, and protect those at the top when everything finally broke. When the collapse came, it didn't just wipe out banks. It erased livelihoods, savings, and years of progress for millions of people. And when the dust settled, one fact became impossible to ignore. The people who designed the disaster didn't pay the price. They collected bonuses. For ordinary people, 2008 felt like whiplash. Housing prices had been climbing. Credit was easy. Jobs seemed stable. Then, almost overnight, the economy seized up. Major financial institutions failed. Retirement accounts cratered. Foreclosure signs spread across neighborhoods. And as fear took hold, governments rushed in with staggering sums of money, not to households, but to financial giants deemed too big to fail. To understand how this happened, you have to strip away the jargon and look at incentives. In the early 2000s, Wall Street was searching for its next engine of profit. The tech bubble had burst, and traditional investments weren't delivering returns fast enough. Real estate became the solution. Housing wasn't just shelter, it was collateral, leverage, and a financial product waiting to be scaled. Banks began turning home loans into tradable assets. Thousands of mortgages were bundled together and sold as securities to investors around the world. The pitch was simple: steady returns backed by real property spread across many borrowers. It sounded safe, but safety requires discipline, and discipline disappears when profits explode. As demand for these securities grew, banks needed more mortgages to feed the pipeline. When qualified borrowers ran out, standards collapsed. Loans were issued with minimal verification, low introductory rates, and repayment terms designed to fail later. The goal wasn't repayment, it was volume. Risk didn't disappear. It was redistributed and disguised. Then came the second layer: financial bets stacked on top of these mortgage bundles. Investors could now wager on whether loans would succeed or fail, multiplying exposure without adding real value. Failure itself became profitable. The system no longer depended on stable homeowners. It thrived on churn, leverage, and collapse. Overseeing this mess were credit rating agencies tasked with judging risk. But they weren't independent. They were paid by the same banks selling the products. Predictably, toxic assets were stamped as safe. Warnings were silenced. Complexity became camouflage. By the mid-2000s, cracks were already visible. Housing prices were rising far faster than incomes. Entire developments sat empty. Speculators flipped properties they never intended to live in. It looked like growth. It was excess. When interest rates adjusted upward, the illusion shattered. Monthly payments jumped. Defaults surged. Foreclosures spread. And suddenly, assets once valued as rock solid were revealed to be fragile and overpriced. In 2008, the system imploded. Major institutions collapsed or teetered on the edge. Credit markets froze, trust evaporated, global trade slowed. In a single year, trillions in household wealth vanished. People lost jobs, homes, and retirement security, often permanently. And then came the rescue. Governments and central banks unleashed unprecedented interventions: bailouts, emergency loans, liquidity injections. The justification was always the same: saving the system would save everyone. But that's not what happened. Financial institutions stabilized quickly. Markets recovered. Executive compensation rebounded. Meanwhile, unemployment lingered. Foreclosures continued. Wages stagnated. The recovery flowed upward, not outward. The crisis revealed a harsh reality. Modern finance is designed to preserve itself first. In the years that followed, central banks doubled down. Interest rates were pushed to historic lows. Trillions were created digitally to inflate asset prices and restore confidence. The strategy worked for those who owned stocks, property, and financial assets. For everyone else, life became more expensive. Then came 2020. When the global economy shut down, policymakers responded with even larger interventions. Massive stimulus, near zero rates, emergency lending on a scale never seen before. It felt like a breakthrough, as if money could solve anything, until inflation returned. By 2021, prices surged across essentials. Central banks reversed course, raising rates aggressively. Markets stumbled. Debt became painful again. And once more, the fragility of a debt-driven system was exposed. Today, the same foundations remain: high leverage, concentrated financial power, complex products few understand, a system dependent on constant intervention to avoid collapse. So what does 2008 teach us? First, complexity is not protection. It often hides risk rather than eliminating it. Second, incentives shape behavior. If failure is rewarded with rescue, recklessness becomes rational. Third, understanding money is no longer optional. It's defensive knowledge. Crashes don't repeat perfectly, but they rhyme. And when the next one arrives, the response will be familiar. Protect markets, stabilize institutions, and let the consequences spread quietly through everyday lives. The system won't warn you, but history already has.